Welcome to our budget briefing, all about what happened yesterday, perhaps what didn't happen yesterday. No irony to me that today is Thanksgiving Day. I'm not sure where that sits in relation to Rachel Reeves, but maybe there's a bit of irony in there somewhere. Budgets come normally once a year, thank heaven, because the amount of work they create is astronomical. So they come once a year, and this year's has been a bit unusual because, as I'm sure you all know, you'd have to be hiding under a rock not to know, over the past few months there has been absolutely tons of briefing, counter-briefing, rumours and everything else. What's been unusual this year is that normally it's people like me, solicitors, the accountants of the world, that start getting really concerned about forthcoming changes. And we start speculating, we start guessing, and we start telling people what to be worried about, what not to be worried about, etc., etc., etc. The unusual thing this year is how much the politicians have been doing that, even as far as Rachel Reeves holding her press conference in Downing Street, saying that what's going on. And then, of course, we got to yesterday. And to cap it all, we ended up with the entire budget speech being leaked an hour early via the Office of Budget Irresponsibility. So we ended up with the entire thing coming out sooner than it should have been. You may have seen Rachel Reeves having to backpedal and sort of cover her tracks on that early on in the speech. An awful lot of criticism has been levelled by the Commons on this subject. I don't think we've heard the end of it yet. So really, I said today is Thanksgiving Day. I think yesterday really was National Leak Day. So that's hence the previous slide. And if we remember what the Office of Budget Responsibility are supposed to be there for, they were introduced in the 2010 coalition government as an office to impartially observe and comment upon what the Chancellor and the government were trying to do with the economy. Yesterday, they had a good chance of wrecking it, but never mind, I'm sure. We've all sent emails accidentally. I don't think any of us have sent any quite that consequence, though, luckily. So with that backdrop, let's think what was actually in the budget. The things I'm going to be covering today are income tax changes, capital gains tax changes, inheritance tax changes, corporation tax, national insurance, VAT changes. Quite a big, significant move on electric cars, and I think it's more significant than we might have first thought, but it is really quite an important thing about electric cars. And then some other stuff at the end. I must confess, at the end of the speech, I do what I always do, logged on to all the various government press release sites, just trying to find out what was going on. And there wasn't a huge amount of meat in it, if I'm honest. So sort of started preparing today without a lot on it. So we are kind of covering perhaps areas that you might not have expected me to cover in ordinary circumstances. But onwards. Let's talk about income tax. We are looking at a 2% extra tax on dividends. Now, it's interesting, there are some inconsistencies here. Dividends are having 2% added onto them. So for basic rate taxpayers, the dividend tax rate 10.75, not 8.75. The higher rate taxpayer 32.75, but the absolutely highest rate of taxpayer has not moved. It's 39.35%. So there's movement there, but not for the very highest earners on dividends. That's coming in 2026, so that's April next year, rapidly approaching. Extra 2% on interest received, 22, 42, 47. That's not coming into a year later. And the same on rent, 22, 42, 47. So it is a bit strange that we're seeing different years. So I'm trying to click people in at the same time. Different years at the same coming in at different times. So they are our income tax changes predominantly. All thresholds, so the amount of earnings you have before you pay higher rate tax or the very highest rate of tax, are frozen until 2031. So that's further than we first thought. So it was announced yesterday a further freeze, which of course means that there is an effective tax rise due to inflation. If you think that inflation from 2019, sorry, clicking somebody else in, inflation from 2019, just before COVID to date, has basically added 60% onto the average cost of living, but tax thresholds haven't moved over that period. So you can guess the effect of that on all of us. Because of this rise in dividends, those that are clients, and we talk about how we extract profits, whether we take salaries, dividends, or some other method, we are going to have to be looking at that quite critically as we go forward, because I think almost certainly the balance will have shifted in most people's cases, that it may well now be cheaper in tax terms to take it out by way of salary, albeit with a national insurance cost, because the company gets tax relief. It may well be cheaper in most cases than taking dividends, which is certainly a bit of a change from a few years ago. So let's move on and look at the capital gains tax changes. What changes were there in yesterday's budget speech about capital gains tax? Shall I move on? Frankly, capital gains tax had very, very, very little mention. As someone who's been involved with 3, maybe 4 largish transactions trying to get it through before midnight on the night before the budget Tuesday, it's quite a surprise that actually all that work's gone into to get things over the line in time. Sorry, excuse me, I'll just pick somebody else in. There we go. So we haven't seen any changes at all, really. Again, same point as income tax thresholds are frozen until 2031, and inevitably, you can probably guess the next phrase, that means that the effective tax rise due to inflation. Talking about tax rises when capital gains tax comes in, not an announcement yesterday, but an announcement some years ago, is the annual exemption, which was once £12,000 you could make capital gains tax free. Is now sitting at £3,000. So there's deflation for you at quite some margin. And for those of you that might be affected by business asset disposal relief, sale of businesses, up until a year ago, it was 10% used to pay on the first £1 million of capital gains. Before that, it was 10% unlimited. It now means that it's 14% now as a result of last year's changes. And the other changes that were announced last year will mean that we're talking 18% from April 2026. Not a change from yesterday, therefore, but it's worth bearing in mind it is a change coming through. Let's talk briefly about inheritance tax changes. Again, a lot of talk in the press, a lot of chatter about future changes coming through on inheritance tax. Obviously, there were some huge reforms that were brought in last year that haven't yet bit. So what happened yesterday? Yeah, moving on. The thresholds are announced that they are frozen until 2031. I did mean to look back at how long it's been since the threshold of 325,000 of nil rate band was last looked at. From memory, I think it's about 16 years, maybe more. So there's given inflation, that's a huge effective tax rise. The one thing that was announced yesterday is for those people that will be taking advantage of agricultural property relief and business property relief. You might remember from last year, the big changes came in that the first £1 million of agricultural assets or business assets that were transferred gets agricultural property relief, business property relief at 100%. However, how the legislation was being drafted, and these changes don't come in yet, a couple of years still, how the legislation was being drafted, it looked like if you left everything to your spouse, you would only get the one lot of £1 million, whereas if you left it to, say, children on the first death and then the children get the rest on the second death, you would get £2 million. Well, that has been clarified. The legislation is going to be changed so that if there's an unused band, the band will transfer to the spouse. The other change, it won't affect too many people, Inheritance tax is liable on UK residents on worldwide assets and for non-residents on assets that were situated in the UK. So if we have someone living somewhere, let's say Switzerland, who owns some assets in the UK, they won't pay inheritance tax on. One more person. So somebody living in Switzerland wouldn't be paying inheritance tax on their worldwide assets, but they would be paying inheritance tax on UK-based assets. The situation has been up until now that if you owned UK land, for example, in an offshore company, which was then owned by a non-resident, you wouldn't be paying inheritance tax on that. That loophole is being closed. Non-resident companies owning agricultural properties are now going to be caught within the IHT net. Not quite sure how that's going to work, but it does close off a fairly significant loophole, albeit to a fairly limited number of people. Right, sticking to the agenda, let's move on and look at national insurance changes. What changed in the budget yesterday to do with national insurance? Common theme here, isn't there? Really struggling to see much reference to national insurance at all so far as what's going to be affecting us. Once again, the thresholds are frozen until 2031, which once again means an effective rise. The one thing that will affect a surprising number of people is that salary sacrifices made of over £2,000 will be liable to national insurance. Now let's talk a bit about salary sacrifice because it might be a slightly unusual concept. This is where somebody, for example, is earning £55,000 where it particularly works well. And they say, well, rather than taking my entire salary that I'm entitled to as a salary, and maybe if I'm 55,000, I'm paying higher rate tax and I'm paying national insurance, and you, of course, Mr. Employer, are also paying national insurance, I'd much rather have some of my salary paid into a pension scheme. Reduces my tax bill, no national insurance for employees or employers. Happy days, it works phenomenally well. There are a significant number of people who do this, particularly those that are maybe approaching retirement age. With effect from April 2029, if the amount that's being sacrificed is more than £2,000 per annum, then there's going to be a national insurance charge both for the employer and the employee. Not sure how this is going to work for entirely voluntary contributions, but it's certainly going to catch those where there is a contractual obligation, a contractual right for a salary of X, and the person is saying, well, I don't want all of that, I'll take something to a pension. Interesting that this was trawled as an attack on the wealthier bankers who are taking huge amounts. Were that to be the case, in truth, I'm not entirely sure that we'd be setting the limit at £2,000. I think this is going to catch quite a few working people, sort of, which is where the Chancellor is pitching her budget at these days. So watch this space on that. We've got a few years for it to come into place, but it is coming. So corporation tax changes, again, focusing on the headline things. What changed in the budget yesterday about corporation? One of those again. Not a lot, to be honest. Again, got very, very excited in the run up to the budget. Lots of speculation about rate increases and stuff, but no, thresholds and corporation tax rates remain frozen. Don't need me to tell you that that means an effective tax rise due to inflation, and it's going to be staggering if one could even get into the sums to find out how much extra the nation are taking from us all as a result of inflation and rates and thresholds not moving. One thing that talking about inflation, did inflate, the late filing penalties are doubling with effect from April next year. So if there's anyone on this call who's worried about meeting their deadlines, we've got a particularly more important thing to worry about going forward. It's going to cost more to miss. VAT changes. What was announced yesterday in the budget about VAT? Again, headline things. Yeah, not a lot, if I'm honest. there was a lot of speculation about the registration threshold going up or indeed going down. It's been held at £90,000 per annum. It was 85 a couple of years ago, so there has been some movement there, not yesterday's news. But at 90,000 per annum, we are certainly seeing smaller businesses that one wouldn't normally expect to be in the VAT net a bit now being caught, because inflation is basically pushing their sales up, just natural inflation. You can't really run a hairdressing salon now for less than that as sales, and therefore sort of two-chair hairdressing salons are being caught within the VAT threshold. 10 years ago, that would have been unthinkable. Something that may have an impact on us, on our household costs, customs duty for relief for goods below £135. Key thing here, if I go and buy, I don't know, a pen in the high street, VAT is charged on it. If I buy a pen through an online seller and it gets imported to me from China, if that pen costs less than £135, which one would certainly hope it would, then I wouldn't pay any VAT at port of entry. That is the high street retailers have been lobbying quite hard on this not being a level playing field. And with effect from April 2029, this £135 relief is being abolished. So it will sort of make sure that costs are the same whether they're being bought in a physical shop or an online shop. Again, lots of regulation got to go in to make that happen. I think there's at least one freight forwarder on the call. He might be excited about that. Oh, here we go. Electric cars. In my book, that's the only sort of electric car that should be allowed, but never mind. Electric cars. Few changes on electric cars. One of them is sort of welcome. And we're talking about inflation here. There is an extra tax that is levied on electric cars that cost £40,000 or more. That's now been lifted to £50,000 or more, probably reflecting the fact, well, from April 2026, probably reflecting the fact that electric cars, by their very nature, are more expensive than their more sensible counterparts. There is an electric car grant. If you're buying a new qualifying car, you can get as much as £3,750 off that car cost through the electric car grant scheme. That has been extended. I read a really exciting headline that you can now buy a Nissan Leaf. Can I hear those screams of excitement in the background? You can buy a Nissan Leaf under this scheme now, which of course is brilliant news. If you drive a Nissan Leaf, though, with effect from 2028, you will be paying 3p per mile for electric car usage. I drive a hybrid, and I was not happy about the next one. 1.5p per mile for plug-in hybrids. Not such good news for people that are sort of half doing the right thing, I guess. Now, I like to think that people in government are quite intelligent people and know an awful lot and think things through properly before they announce things. So I was quite interested to know how they're going to know how many miles I'm driving in my car over the course of a year. So I logged on to one of the very, very, very lengthy documents on this subject on the government website last night. And I started to read it, and I'm getting more and more angry about how little thought has been given to this. They actually have no idea how they're going to know how many miles we're driving. So there are lots of proposals in this document, and they're seeking consultation from all and sundry as to how to make it work. Suggestion number one is we're going to tell them at the start of the year how many miles we're going to drive. Oh, could there be a problem there? Yeah, so I've got an electric car sitting on my drive or a hybrid. I've got to tell them a year in advance how many miles I'm going to drive. And then there's got to be a verification of whether I told the truth or whether I got my estimate wildly wrong. Okay, so they're suggesting that's done through the MOT scheme. Because, of course, as we all know, those of us that have got over 3-year-old cars, on the MOT certificate, it states your mileage. So you can track the mileage. And of course, that feeds into the government. Well, that's kind of okay. But what about the car that's not 3 years old? The leased car that is leased for 2.5 or spot on 3 years. How does that get caught? And there is then a suggestion that there will need to be an inspection at an annual point. on the car, a bit like an MOT, but just to get the mileage off. And you kind of, my head is boggling at this point. We're now requiring cars to go and have their mileage verified. There is a suggestion that there might be some kind of tracking mechanism put on your electric car. Well, if there's ever an argument for not having an electric car, that's it in my book. I do not want the government knowing where I'm going. Very few people I want knowing where I'm going, to be honest. But that was one suggestion. And of course, the other point here is if I tell the government what I'm going to do a year in advance, and then I write the car off after a week, or I sell the car after a month, how does that all work? I'm paying up front for something I'm not then using. It just feels like an absolute nightmare. I'm sure before 2028 they'll get there, but at the moment I have no clue how that's going to work. Moving. Oh, somebody else now joining us. Missed all the fun bits. Let's talk about some other stuff. A bit more boring than cars, to be fair. Capital allowances. Not many businesses these days still have an 18% written down allowance pool. It's only going to be some of the larger businesses. But if they have, the 18% per annum writing down allowance is dropping to 14%. Businesses that qualify, that's most in reality, businesses that qualify for either full expensing or annual investment allowance on capital expenditure, that has been both of those have been temporary reliefs. They are being maintained. And there is an extension for businesses that would qualify for those, and the obvious one being leasing businesses that will get a 40% allowance going forward. Business rates, this is a fairly narrow area, but for those that are in a property that qualifies under the small business rates relief not to pay business rates, there is this huge sword of Damocles that you can only have one property that qualifies. So if you want to expand and go to your second property, suddenly you're paying rates on both properties, which is a huge kind of hurdle to overcome. There was a little while back, they brought in a 1-year transition to enable you to get over that. That 1-year transition has now been extended to a 3-year transition. So in other words, one property qualifies for small business rates relief. You buy or acquire or lease a second property, you can have that second property for 3 years without paying business rates on the first one. And there's been a relaxation of sorts on the multipliers that will be applying to hospitality, leisure industries, just to try and help those industries out that are struggling. Construction industry scheme, I know at least one person joining has experience of this. The scheme is changing to improve compliance. I think most people would recognise the construction industry is a slightly odd one. Builders still do work for cash. And the construction industry scheme is very much kind of trying to improve tax compliance in the construction industry. They've been trying to improve compliance using the CIS for at least 50 years, and every now and again it gets tweaked, and yet it's still not a very compliant sector of the economy. Moving on. There's some really boring stuff, but I thought I would pick up on this because there's a couple of interesting things in it. Every budget, the Chancellor will always talk about anti-avoidance and how they're going to stop people avoiding tax. Inevitably, it cropped up yesterday. There's a very, very, very lengthy press release about how they're extending the anti-avoidance rules on transactions in securities. If you really are struggling to sleep, I can send you the link to it. It's going to affect very few people, but it's quite complex. And if one is in a situation of management buyout or a sale of a business involving an earn-out, it will have an impact on that. Yeah, the next one I wasn't massively keen on. Lots more burdens on agents and accountants. And I'm just going to read you what PricewaterhouseCoopers has said overnight. The government is proposing significant changes that will have significant implications for all tax advisors, not just a stated target of bad actors. Whilst the details need to be studied, it is very likely that these measures will lead to increased compliance burdens for all cases and very real risks on compliant advisors that will significantly increase the cost and complexity of obtaining tax advice. There. You've heard it from PricewaterhouseCoopers. What more can I say? The government talked a lot about reducing red tape, and yet we're going to see an significant increase on all of us doing our tax returns and all of us doing our company accounts, etc. Government are investing £59 million, a very precise amount of money, to aid compliance. They're investing this in IT. Frankly, to put a zero on the end, based on my experience of HMRC computers, it wouldn't be enough. And crypto reporting. There is an enhanced requirement for crypto providers, crypto exchanges, to be reporting UK taxpayers who are dabbling. Enterprise investment scheme, venture capital trusts. I know there's at least one person on the call interested in this kind of thing. Thresholds are being extended, and the scheme is basically changing to improve compliance. I mean, basically, they're trying to make this more open to people. Not quite sure how they're going to do that, but there's a lot of consultation being taken place on this subject. Making tax digital. This has been the real hot potato talking to clients for the last 12 months or so. Making tax digital basically means if we are a landlord, whether joint or sole, whether we are a sole trader, if we've got turnover or gross income in a landlord's case of more than £50,000, we are now April next year. Let's face it, that's 4 months away. We have to be doing quarterly tax return filings. Luckily, and also this has been very heavily lobbied by the accounting profession, there will be no penalties for late filing in 26-27. Basically, for those that haven't come across this before, the quarterly tax returns are, as the name suggests, quarterly tax returns made 4 times a year, and there will be 37 days or 38 days or 35 for February. It's 1 month plus 7 days deadline to get these in. So it's a very kind of onerous regime that we're being forced into here. Late filing penalties are going to become quite rife, I fear, as time goes by. But in 26-27, there'll be a waiver of them, which is good stuff. Mansion tax. Properties worth more than £2 million, if you're living in them, will bring with them a £2,500 extra council tax burden. And this is coming in April 2028. And if you're lucky or maybe unlucky enough to have a house worth £5 million or more, and bearing in mind this is the house value, not necessarily the equity in the house. You could have a house worth £5 million with a £4.9 million mortgage. You'd still get caught. The £5 million threshold is £7,500 per annum, and there's a sliding scale between those two. Not entirely sure how that's going to be administered, but it is coming along to catch us. Share options. We've got a very generous share option scheme for qualifying companies. If we want to grant shares or similar to key employees, there's a scheme called the Enterprise Management Incentive. We come across them from time to time. The threshold is being increased to catch more larger companies. That is to be welcomed. The thresholds really haven't moved over the number of years. So again, inflation was meaning they weren't kicking in. Not relevant for everybody, but if you have got key employees, it's certainly worth considering whether there's a way to incentivize and lock them in, assuming you want to lock them in. And pleased to know we are getting towards the end of things now. I did say there wasn't a huge amount of meat in the budget. Cash ISAs under 65s at the moment, or it doesn't matter if we're under or over right now, you can put £20,000 per annum into a cash ISA. The attraction of an ISA, of course, is that the interest received on it is tax-free. There are also stocks and shares ISAs where the capital gains, income and dividends are all tax-free. So where we are is that £20,000 applies to either cash or dividend or stocks and shares ISAs at the moment. If you're under 65 from April 2027 and you want to put money into a cash ISA, that's being restricted to 12,000. And the stated argument for that is they want to encourage more people investing in companies. A bit like the Tell Sid campaign of the 80s, I guess. And then we have national living or minimum wage coming in April 2026. Now, I know this is a really hot potato for lots of businesses, particularly those in the hospitality industry. Mentioned already, they're really struggling. Agriculture, this is affecting. And it's easy to say, well, we don't pay our staff minimum wage, we pay well above it. Well, this is, I fear, going to have an impact. For the over 21s, the national living wage from April is going to be £12.71 per hour. Now, to save you doing the maths, I've done it. If you work a 40-hour week for 50 and pay someone 52 weeks a year, that's £26,437 is now the minimum wage. And that's a 50p or a 4% increase. That's quite a big increase when you think about it. We'll move on and look at the 18 to 20s. The 18 to 20s have done a lot better. Their minimum wage is now £10.85 per hour. And I've done the maths there. £22,568 per annum. They've had an 8.5% increase. Crikey, if that's not inflationary, I don't know what is. Anyone who's under 18 or an apprentice, they've gone to £8 per hour. So that's 16,640. They've got a 5.2%. So you can see that there's a real emphasis there that's trying to bring the age gap up, or bring the bottom of the age gap up, if you like, narrow the gap. And I think probably if any of us had 10 years ago thought that the minimum wage would be £26,000 per annum, we'd probably be laughing at whoever it was that suggested it. That's where we are now. Now, why I said, of course, may not affect many people on the call, which would quote, we don't pay people minimum wage. What that means is if the floor's lifted, then so will the expectations for everybody else. If you've got someone that you're currently paying 27,000 a year to, but they're at a higher level than somebody at minimum wage, there's not much of a gap between them. So they're going to be wanting an up. And so it goes on right the way through our entire workforce. And I think that's going to cause, it's going to cause some sort of hard decisions to be taken around recruitment, particularly on the back of the national insurance increase that came in last April. And particularly those businesses that are on the knife edge that are perhaps staff heavy because they have to be, hospitality, those that need to actually be putting people on seats, as it were. And really, that brings me to the end of the presentation. As ever, there's a heck of a lot of stuff out there on government websites and stuff, lots of press releases, lots of consultations, lots of everything. I've really tried to highlight the things that I think are most relevant to the average person on this call. Obviously, if you're a bit more concerned about what to go into anything in more depth there, we can either have a chat now or call me later. And the other thing I want to say is that, yeah, as time goes by, inevitably, some of these proposals will be changing. Some may be watered down, some may be toughened up. So, yeah, watch this space. We are there for you. Let's keep in touch. I have recorded this, hopefully I've recorded this presentation so you can watch it again if you really want to. No, that was a silly idea. And I've also got the PowerPoints available for anyone who wants it. We are later on today going to be issuing a fuller commentary on the budget. So again, if you're struggling to sleep, there'll be something to help you this evening. Just leaves me to say thank you for coming. Has anyone got any questions? Do remember to unmute yourself if you have. Well, there's either no questions at all, or else you've all got the mute button still on. Either way, I suppose that's a good result as far as I'm concerned. So say, well, just say once again then, thanks to you all for coming. Any queries later on today or whenever, you know where we are, and look forward to catching up with you soon, all very soon. Bye for now.